All right, let's talk about a really crucial step in accounting, something that happens way before any of those big, glossy reports get made. It's called the trial balance. And honestly, you can think of it as the very first checkup for a company's financial health. If you get this part wrong, everything that comes after it is pretty much built on shaky ground. So let's dive in and see how it works.
I mean, think about any business. It's just a constant storm of numbers, right? You've got money pouring in from sales, money flying out for rent, supplies, salaries. It's a lot. So with all that going on, how on earth do you know your books are actually accurate? How do you catch one tiny little typo before it spirals into a massive financial headache? Well, that's the exact problem the trial balance was invented to solve.
So, before an accountant even dreams of putting together an income statement or a balance sheet, they have to run a quick diagnostic test. And that's exactly what this is. It's that first checkpoint, a really simple but vital test to make sure the basic math of their bookkeeping actually adds up.
Really, you should think of the trial balance as your first line of defense against total chaos. It's the tool that wrangles all those countless transactions and does a quick check for basic arithmetic errors. It gives you that initial bit of confidence that your numbers are solid before you even think about moving on to the more complicated stuff.
Okay, so what is a trial balance exactly? Let's get into the nitty-gritty and look at the actual definition.
Now that sounds a little formal, right? But the key thing to get here is that this is not a report for investors or the public. Nope, it's a purely internal checkup. You're basically taking every single account from your main record book, what they call the general ledger, and you're just listing out their final balances into two columns, one for debits and one for credits. That's it.
So, why even bother? Well, first and foremost, it's about checking your math. It verifies that your calculations are accurate. Second, it proves the absolute golden rule of accounting is holding true. For every debit, there's an equal and opposite credit. And once you've confirmed that balance, you finally have a solid, trustworthy foundation to start building your official financial statements. The whole idea here is built on something called double entry accounting. This fundamental principle that every single transaction has two sides that are equal and opposite. So preparing a trial balance is kind of like piling all your financial data onto a giant scale to see if it balances. So let's walk through the steps. And the process itself is wonderfully simple. You literally just go through your big book of accounts, the ledger, and you pull the final balance for every single one. All the debit balances, they go in the debit column. All the credit balances, they go in the credit column. And then you get to the moment of truth, you add up both columns. If those two totals match, congratulations, your trial balance is in balance. This slide shows a really great, simple example of what this looks like. You can see things like cash and rent expense have debit balances. These are often assets or expenses, things the company has or spends. Then you've got things like capital and sales with credit balances. That's usually where the money comes from. You list them all out, and boom, if the accounting has been done right, those two totals at the bottom will be exactly the same. Seeing those two matching numbers at the bottom of the page, it's such a huge sigh of relief for any bookkeeper. It means your books are, at least arithmetically, sound. But does a balanced trial balance mean your accounting is absolutely perfect? Flawless? Well, this is where the story gets a little more interesting. And here's the catch. A balanced trial balance can actually lie to you. It's an amazing tool, don't get me wrong, but it is not foolproof. There are some really sneaky kinds of errors that can slip right past this check, hiding in plain sight, even when your debits and credits look perfectly equal. Okay, this is where you see the real limits. A trial balance is a fantastic filter for catching simple math mistakes, no doubt, but it's completely blind to other, sometimes much more serious problems. For instance, something called an error of principle. Let's say you buy a new company car, which is an asset, but you accidentally record it as a simple repair expense. The debit and credit amounts still balance perfectly, but you've completely miscategorized the whole thing. Or worse, compensating errors, where one mistake you made on the debit side is perfectly and accidentally canceled out by a totally different mistake on the credit side. And maybe the biggest blind spot of all, if a transaction never got recorded in the first place, well, the trial balance would have no idea. The numbers would still balance perfectly. So what's the big takeaway from all this? It means we have to see the trial balance for what it truly is. It's not a guarantee of perfection, but it is an absolutely essential first checkpoint. This quote on the screen just hits the nail on the head. It's an internal control tool. Its entire job is to check the math, not the logic, not the judgment, and not the completeness of your accounting. A balanced trial balance is a critical milestone for sure, but it is definitely not the finish line. And that leaves us with one last, pretty important question, doesn't it? If this first checkpoint is just one step in a much longer journey, what comes next? What other processes do you need to go from a list of numbers that just adds up correctly to a truly fair and accurate picture of a company's financial standing? Well, that's a journey into financial statements, deep analysis, and audits, the next layers of the search for financial truth.